So guys and gals, welcome to another one of these short Substack videos. No trade calls, no recommendations, or response for their own stuff here for educational purposes only. 12th of October 2025. So here we go. Again, I'm not going to talk about Trump tweets. I'm not going to talking about more risk into the end of the year, signs of stress in various sectors, poor liquidity, too much leverage in the system, complacency, etc. The point of these Substack videos is to have an extremely short snapshot, trying to keep things very technical. If you're interested in the other stuff, we got the weekly updates or the daily webinars we hold, right? So here, without overcomplicating things, last update we talked about the fact that the action we're seeing at highs suggested that the market was unable to find new buyers at highs, and that we would expect the sustained move higher to be very difficult, and far more likely, seeing that price pattern, that we would go back and test the 10-day moving average. Then below the 10-day moving average, we said don't pay attention to too many of these different supports. What really matters is that 17th of September FOMC day low, right? And that was going to be a level the market would likely want to test, and that would be a key catalyst. Surprisingly enough, that's exactly where the market went, and that's where the market stalled. So right here, in terms of broader pictures, we still have that bull bear line, which was the 6,500, lining up pretty much with that level, lining up with the 50 DMA. And market seems to hold. Now, there's a potential with the taco we've seen over the weekend that the market tries to rally, and here in the Sunday could open up, 2-3%, who knows. But technically, what matters now is how we still deal with that 10-day moving average to the upside. So paradoxically, here we have a key psychological level and a turn point. But if we lose that 50-day, right, I wouldn't be too focused on the 100-day, because if you see this whole kind of structure, when we tend to lose these breaks and get with traction, usually it's not uncommon for the market to unwind that whole move, and that would take us again back into that lower point we were talking about, the 200 DMA, the 2025 open, and that's the level we'd focus on. So again, our bigger levels continue to be 6,800 to the upside and 6,100. And right now, what everybody needs to understand, that inside the 10-day and the 50-day, this is, don't be confused by velocity of move inside range. Likely anything that happens here is, doesn't mean much. Now, we'll have to see if a pop back above brings back animal spirits, gives the bulls a chance to squeeze even higher and then break above the 6,800. But keep in mind, any rip through these highs that can't hold above the 6,800 is still not very bullish. It takes you exactly back to all the discussions and the considerations we're having here. And a break below the 50 DMA, the 6,500, means that we'd be looking for a potential very rapid unwind back into the 6,100, the 200 DMA. But equally, unless we close below that, we're still in a broader range. So going into this week, instead of getting too hung up with the headlines, just focus on the levels. Shorter term, day closes above below that 10-day, and day closes above or below that 50-day are going to be a very good guide. And understanding that inside this range, it's really hard to have any new information, and that this is a very tradable range and likely is going to move very quickly, but you don't really have any new information. And the point is, there's probably the pot odds are probably still stacked up to the downside, in the sense that there's a lot more room to run to the downside than to the upside, unless technically we can close solid day close, weekly close back above the 6,800. Okay. Wishing everyone else, want to talk to you guys soon. Take care. Bye-bye.